Okay, we covered contingent liabilities in the last video, so we're now down to analysis of liabilities. And so we have two ratios here. The first is debt to assets ratio, and to calculate it, we take total liabilities divided by total assets, divide that out, and that gives us that ratio. So that shows us what percentage of assets were paid for or provided through financing, through liabilities, through creditors. Now, that also deals with the amount of what's called leverage. More highly leveraged companies have a higher debt to assets ratio, meaning they pay for more of their assets through debt than through money provided by owners or equities. Where would you expect to find that? Well, highly leveraged companies, it might be about 65%, which would be about 2/3 of the assets are provided by creditors or by debt, and 1/3 by owners. More conservative companies, it might be more in the 1/3 or 33% range, in which case 2/3 or 70%, 67% is provided by owners. Now, most companies, most big companies, number one, don't desire to be debt free. They recognize that a certain amount of leverage is a good thing. And the idea there is that if I'm running a business and you're an owner and you give me $1 to put to work for you in the business, and I can earn a 10% return on that dollar, then you give me the dollar and I earn you 10 cents. Now, if you give me $1 and I go borrow $1, and let's say I pay 6% interest on that dollar I borrow. So you give me $1, I go borrow $1, then now I have $2 to put to work. So I earn 10%, 20 cents on those $2. I pay 6% interest on the dollar I borrowed, or 6 cents. So now on your dollar that you gave me, I earned 14 cents. So that's why most companies prefer to have some amount of debt. Most big companies' debt to assets ratio is about 50%, anywhere from 40% to 60% is considered reasonable. If you get more than about 60% debt, that starts to get a lot higher risk. And the reason it's higher risk is if we have a bad year, I still have to pay interest on the debt, but I do not have to pay dividends on the equity. So in a bad year, the interest can put you in a bind. Okay? So that's debt to assets ratio. Now, times interest earned tries to see how well did you, how much of a cushion did you have, or how well did you do it providing money through earnings to cover your interest that you had to pay during the year. Now, to calculate this, we take net income plus our interest expense, because that's interest we did pay, plus income tax expense, and divide it by interest expense. Now, you may be wondering, well, why do we throw income tax expense in there? Well, the answer is if we have no net income and we had only enough money to pay the interest expense, but no net income, we wouldn't have had any income tax expense. So, therefore, whatever money we paid in income tax, potentially, if we had no net income, that money wouldn't have had to be paid there either. Now, in case you're saying, well, gee, that doesn't make a lot of sense, it's the finance people that make these up. We just calculate them for them. So, but that's how you calculate it. So net income plus interest expense plus income tax expense divided by interest expense. Now, obviously, the higher this ratio is, the safer your investment is, or your loan is. And here, the lower this ratio is, then the less risk that's undertaken by loaning money. Okay, your book explains those down in here. They explain what they mean, how they get to them, how you calculate them. Let's look at a couple of homework problems on them. So here we have mini exercise 1013, and that's the first one. The balance sheet for Shaver Corporation reported the following: cash, $5,000, short-term investments, $10,000, net accounts receivable, $35,000, inventory, $40,000, prepaids, $10,000, prepaids, that's prepaid expenses, that's an asset, $10,000, a current asset, equipment, $100,000, current liabilities, $40,000. Note payable long term, $70,000. Total stockholders' equity, $90,000. Net income, interest expense, income before income taxes, and compute their debt to assets ratio and their times interest earned. So to get income tax expense, we're going to have to subtract income before income tax. We're going to have to take that amount and subtract net income from it. Now, to be honest, you really don't need to do that, because this amount, income before income tax, gives you net income plus income tax expense. So all we would have to add to that then is the amount of interest expense to get the numerator in the times interest earned calculation. So to do debt to equity, debt to assets ratio, we need to calculate our total assets, so we can add all those up. So 5,000 plus 10,000 is 15,000, plus 35,000 gives you 50,000, plus 40,000 gives you 90,000, plus 10,000 gets you to 100,000, and then 100,000 plus 100,000 gives you 200,000 in assets. We have 40 plus 70,000, 40,000 plus 70,000, or $110,000 in liabilities. So we have 110,000 divided by 200,000 gives us a debt to assets ratio of 0.55, or 55%. Now for the times interest earned, notice down here they took income before income taxes, subtracted net income to get the amount of income tax expense. Then they took income tax expense, added it in here with net income to interest expense. So if you'd just taken this amount, all you'd have to do is add interest expense and then divide by interest expense. So we get 2.2. They had 2.2 times the amount of interest they paid in money that could have possibly been used to pay interest. Now, let's go back to the problem. So we're to calculate the ratios, and we've seen that. Based on these ratios, does it appear Shaver relies mainly on debt or equity to finance its assets? Well, 55% on debt, 45% on equity, so more on debt than equity. Is it probable that Shaver will be able to meet its future interest obligations? Yes, they had 2.2 times interest earned. So with times interest earned of 2.2%, yeah, they should be able to pay their interest. So debt to assets ratio is 0.55, which indicates that it has financed more than half of its assets with liabilities. That's what I said. implies that the company relies more on debt than equity. The times interest earned ratio of 2.2 indicates that Shaver has earnings that are more than double what it needs to cover its interest expense. Yes, it appears that they'll be able to pay interest as it comes due. Now, we also had exercise 1010, and so that's right down here, and we will go over and look at the problem. So exercise 1010 is right there. So on May 31st, 2016, FedEx Corporation reported the following amounts in millions in its financial statements. So we get total assets and total liabilities. Compute the debt to assets ratio and times interest earned to 2 decimal places for 2016 and 2015. So 2015, here we had assets of 36,500,000,000 and liabilities of 21,500,000,000. In 2016, 46 billion and 32,200,000,000. So we can divide those out and just let them do the math for us. So for 2015, the debt to assets ratio was 0.59. For 2016, it's 0.70. So we see that the debt to assets ratio went up, or they're relying more on debt. That's one of the questions they're going to ask in a minute. And for the times interest earned, we have to go back over here and pick up. There's interest expense for both years. There's income tax expense and net income. So we just add the three of those together and then divide by the interest expense. And we see that comes up to 7.79 for 2015, 9.06 for 2016. So then requirement 2. Use your answers in requirement 1 to determine whether in 2016 creditors were providing a greater or lesser proportion of financing for FedEx's assets. That was greater proportion, and FedEx was more or less successful in covering its interest cost as compared to 2015. And so, whoops, I don't remember what those ratios were. So greater amount of debt used. Creditors were providing more of the funding in 2016 than 2015. And yes, their ability to cover interest actually went up in spite of that. So debt to assets has increased, suggesting creditors are providing a greater proportion of financing of FedEx's assets, and times interest earned ratio has increased, so suggesting FedEx is more successful at covering interest costs through profitable operations. All right, that gets us to the end of the homework. Now, next we have straight line amortization of the premium or discount. I didn't give you any homework problems on that. I'm not going to hold you accountable for it, but I did explain it earlier. But remember, when we have sold bonds at a premium, our cash interest payments are greater than our cash expense, because part of what we are paying is refunding them their own premium that they paid us. Where bonds were sold at a discount, the interest expense is greater than the cash paid, because we're also taking part of that discount and eliminating it, so that money will be paid to the bondholders on maturity of the bonds. I'm not going to hold you accountable for the effective interest method of amortization, nor for the last appendix here on simplified methods. So we are through with this chapter. I think there's one more appendix, yeah, installment notes payable, and we're not going to cover that. So this concludes the lectures on this chapter.